Today, we're breaking down a common criticism that Bitcoin isn't really decentralized. Welcome to Bitcoin Bytes HQ, simple Bitcoin explainers. This is educational content only, not financial advice. Let's go. Critics often argue that Bitcoin's decentralization is mostly marketing hype. They point to mining pools, large companies, governments, exchanges, and even the internet itself as signs that power is concentrated. On the surface, it can look like a few entities could control the network. But let's go through these claims one by one. First, mining. Critics often say Bitcoin isn't decentralized because a few mining pools and large mining companies control most of the hash rate. Mining pools are groups of miners who combine their computing power to earn more consistent rewards. Large companies like Bitdeer, which reportedly manages over 70 exahashes per second of hash rate, contribute a significant portion of that power. To the average person, this can look like just a few players are running the system. But this is where the structure matters. Mining pools don't control miners, they coordinate them. Individual miners can leave a pool at any time and redirect their hash power elsewhere. We've seen this happen before, where miners shifted between pools to signal disagreement with changes. And more importantly, miners don't decide the rules, nodes do. There are thousands of independent Bitcoin nodes around the world, verifying every block and transaction. Even if large mining pools or companies worked together, they still couldn't change the rules unless those nodes accepted it. This isn't theoretical. In 2013, a software bug caused a temporary split in the blockchain, and it was the nodes rejecting invalid blocks that brought the network back into consensus. Next, large holders. Critics point to companies like MicroStrategy or asset managers like BlackRock and assume that owning a lot of Bitcoin means controlling it. But ownership doesn't equal control. MicroStrategy, for example, holds roughly 3.5% of the total supply, and even combined with other large institutions, that number is still only around 5 to 10%. That's nowhere near a controlling share. And even if it were, what would they actually do with that control? If a large holder tried to manipulate the network, freeze transactions, or break trust in Bitcoin, they would be destroying the value of their own holdings. Their incentives are aligned with Bitcoin working properly. They benefit from a secure, trusted, decentralized system, not from undermining it. Then there's the idea that governments could shut Bitcoin down. This is one of the most common concerns. People assume that with enough regulation or coordination, governments could simply stop it. But Bitcoin doesn't run in one place. It runs on thousands of independent nodes and miners across the world. A government can ban mining or exchanges within its own borders, but it can't shut down the global network. Activity just moves elsewhere. And Bitcoin transactions are just data. They can be transmitted in multiple ways: peer-to-peer trading, satellite broadcasts, mesh networks, and even experimental SMS-based methods all show that Bitcoin doesn't rely on any single communication channel. What's interesting is that the trend isn't toward global bans. It's toward adoption and experimentation. El Salvador has made Bitcoin legal tender. Some central banks, like the Czech National Bank, have experimented with holding Bitcoin, and other governments end up accumulating it through law enforcement seizures. Instead of shutting it down, many are trying to understand or integrate it. Another criticism is that centralized exchanges make Bitcoin dependent on middlemen. After all, most people buy Bitcoin through platforms like Coinbase or Binance. But exchanges are optional. They're just on-ramps. You can send and receive Bitcoin directly, peer-to-peer, without any intermediary. Platforms like Bisq enable this, and self-custody wallets let users hold and transact without relying on a third party. Exchanges don't control the protocol, and they can't change the rules of the network.
Some critics also point out that Bitcoin depends on the internet, which is controlled by governments and service providers. And it's true. Bitcoin uses network infrastructure, just like banks, email, or any modern system. But it also has built-in redundancy. Blockstream Satellite broadcasts the blockchain globally. Mesh networks allow devices to communicate without traditional internet access. And there have been demonstrations of Bitcoin transactions being transmitted over SMS. The key point is that Bitcoin isn't tied to any single system. It can adapt and route around disruptions. Another important distinction is between Bitcoin and other cryptocurrencies. Critics often lump everything together and say crypto isn't decentralized. But many major altcoins operate very differently. Ethereum is heavily influenced by Vitalik Buterin and the Ethereum Foundation. XRP is closely tied to Ripple Labs. Binance Coin is controlled by Binance. These systems have identifiable leadership and decision-making structures, which can become points of influence or pressure. Bitcoin is different. It has no central founder, no company in charge, and no single group that can push through changes without broad agreement across the network. And we've actually seen what happens when there isn't agreement. Instead of one side taking control, the network can split, creating what's called a fork. Different groups follow different rules, and users choose which version they want to support. That's how Bitcoin forks like Bitcoin Cash were created. No one was forced to accept those changes. The original Bitcoin continued separately, and the market decided which version had value. If you want a deeper breakdown of that, I covered it in my video on Bitcoin versus its forks. Finally, some argue that decentralization itself isn't even a benefit. They say people prefer trusted authorities, and that code as law leaves no one accountable when things go wrong. And that's a fair point. Decentralization isn't always better in every system. But in Bitcoin, it solves a specific problem, creating money that no single entity can control. The lack of a central authority is an intentional trade-off. You don't get customer support if you make a mistake, but you also don't have anyone who can freeze your funds, block your transactions, or change the rules without your consent. The system is enforced by transparent rules and global consensus, not by trust in an institution. So when people say Bitcoin isn't decentralized, they're often focusing on surface-level concentration, like mining pools, exchanges, or large holders, without looking at how the system actually works underneath. Decentralization in Bitcoin is about who controls the rules, and in Bitcoin, that control is distributed across thousands of independent nodes, participants, and users around the world. No single entity, not a miner, not a company, not an exchange, and not even a government, can unilaterally change how it works. That's Bitcoin decentralization, explained. If this helped, like, share, and subscribe for more Bitcoin explainers. Drop your biggest takeaway in the comments. I'd love to hear your thoughts. See you in the next one.